Ever wonder why some investors always seem to know when to snap up a property? In today's video, we're diving into the art of analyzing deals in commercial real estate. Now, why is this important? Well, whether you're looking to invest, sell, or simply understand the market better, knowing how to break down a real estate deal can save you time, money, and a lot of headaches. In this video, we'll walk through the essential steps to dissect any commercial property deal. Let's get started. All right, let's get into the nitty-gritty of analyzing commercial real estate deals, starting with data collection. You might be wondering, what exactly do you need to gather? Well, think of it like baking a cake. You need the right ingredients to ensure it comes out just right. First up, financial documents. These are your recipe cards. You'll need the property's past and current financial statements, which include income and expense reports, tax returns, and rent rolls. These documents give you a snapshot of the property's financial health and profitability. Understanding the numbers here is crucial because they tell you whether the property is actually making money or just eating up cash. Next, market data. This is like checking what similar cakes are selling for. It helps you understand the property's value in the current market. Look at similar properties in the area, known as comparables or comps. What are their selling prices? What's the average rent? This data helps you spot trends and decide if the property is priced right. Lastly, you can't forget about property specifics. This is your quality check. What's the condition of the property? Are there any major repairs needed? What are the zoning laws? These details can heavily influence the value and potential profitability of your investment. By collecting these pieces of information, you're essentially putting together a detailed picture of what you're investing in. Think of it as doing your homework before the big test. The better prepared you are, the smarter your investment decisions will be. Moving on to the financial analysis, this is where things start getting really interesting. Have you ever looked at a deal and wondered how investors decide if it's a good buy? Well, today you're going to learn just that. First, let's talk about assessing cash flows. Cash flow is the money left over after all the property expenses have been paid. Think of it as your profit margin. How do you calculate it? Start by adding up all the income from the property. This includes rent, parking fees, laundry services, and any other income-generating activities. Then, subtract all the operating expenses. These are costs like maintenance, management fees, taxes, and utilities. The number you get shows if the property generates enough cash to cover its costs and yield profit. Now, onto some key metrics that every savvy investor should know. The cap rate, or capitalization rate, is a popular one. It helps you evaluate the return on your investment based purely on income operations. You calculate it by dividing the net operating income by the property's purchase price. A higher cap rate usually indicates a potentially more profitable investment. Another crucial metric is the net operating income, or NOI. This is the total income from the property minus the operating expenses, but before any mortgage payments or taxes. It's a great indicator of the property's operational performance. But how do these figures help you? By comparing them with similar properties or industry averages, you can determine whether the property stands out as a good deal or if it's likely to be a money pit. Understanding these financial aspects is like having a GPS in the world of real estate investing. It points you in the right direction and helps you avoid getting lost in bad deals. And just like any journey, the more accurate your map, the better your chances of reaching your destination successfully and profitably. Now that we've covered the financials, let's zoom out and look at the bigger picture with market analysis. This step is all about understanding where your property fits within the broader market landscape. Think of it as positioning your boat correctly to catch the best wind. It's not just about the strength of the boat, but also how well you can navigate the waters. First, consider the local market conditions. What's happening around the property? Are businesses booming or are stores closing down? Look at the employment rates and economic activities in the area. A strong job market typically drives demand for real estate, making properties more attractive. It's also smart to keep an eye on new developments and infrastructure projects. Are there new offices, parks, or transit lines being built? These can significantly boost property values and improve rental demand. Next, perform a competitor analysis. Here, you're sizing up your property against others in the same area. How does your property compare in terms of size, condition, and amenities? Are you offering competitive rental rates? This step helps you identify your unique selling points and potential weaknesses. It's essential for setting the right price and for marketing your property effectively. Understanding these market dynamics can also help you predict future trends. Is the area becoming more popular? Are certain types of properties in higher demand? This information can guide your decisions, not just for buying and selling, but also for upgrading properties to meet market needs. Market analysis isn't just about capturing the current state of affairs. It's about forecasting and strategizing based on solid, current data. By doing this effectively, you position yourself to maximize returns and minimize risks. You'll know if the wind is likely to change and how to adjust your sales accordingly. Now let's talk about risk assessment. This is where we put on our detective hats and look for anything that could go wrong with our commercial real estate deal. It's crucial because, as you know, higher potential rewards often come with higher risks. Understanding these risks can help you prepare better and potentially avoid costly mistakes. First, there's market risk. This refers to the overall risk that economic fluctuations or changes in the market could negatively affect your investment. For instance, what if the local economy takes a hit and businesses start closing? What happens if there's a sudden oversupply of properties leading to lower rents and property values? Monitoring economic indicators and market trends can help you anticipate and mitigate these risks. Financial risk is another big one. This involves the property's ability to generate enough income to cover its expenses and debts. What if your major tenants leave, or you face unexpected high maintenance costs? To manage this, it's important to have a robust financial analysis in place, as we discussed earlier, and maintain a healthy cash reserve. Legal and regulatory risks are also key. These include changes in zoning laws, environmental regulations, and compliance requirements that could affect your property. For example, what if new regulations restrict what you can do with your property or increase the costs of holding on to it? Staying informed about legal changes and working with knowledgeable legal professionals can protect you from surprises. Finally, let's consider the physical condition of the property. Unexpected problems like structural issues or the need for major repairs can also pose significant financial risks. Conducting thorough inspections and evaluations before purchasing a property can save you from these hidden pitfalls. So, we've collected the data, crunched the numbers, and evaluated the risks. Now comes the exciting part: decision-making. This is where all the information we've gathered starts to really pay off. How do we use this data to make smart choices about commercial real estate investments? Let's break it down. When it comes to making decisions, integrating all the insights from our analysis is key. You need to weigh the financial viability, market positioning, and risk factors together to see the full picture. Ask yourself, does the return justify the risks? Are the market conditions favorable for this type of investment? Is there room for growth or improvement that could increase the property's value? One effective way to organize your thoughts is by creating a comparison chart or a decision matrix. List your potential properties and rate them against various criteria, such as location, income potential, risk level, and investment costs. This visual approach helps you compare options side by side and identify which property stands out as the best choice according to your investment criteria. Remember, no investment is without risk, but by making informed choices, you can significantly increase your chances of success. It's also crucial to stay flexible. The real estate market can change, and new information can come to light. Be prepared to reassess your decisions and adjust your strategy if necessary. It's not about making the perfect choice on the first try. It's about being responsive and making the best decision with the information at hand. To explain this further, we're diving into a real-life example of how to analyze a commercial real estate deal. Let's say you're eyeing this property, priced at a cool $2 million. Sounds like a lot, right? But how do we know if it's actually worth that much? Let's break it down together. First off, what's this property pulling in? Imagine it's got tenants paying rent that adds up to $300,000 every year. That's our total rental income. Now, running a property isn't free. There are costs like maintenance, management fees, taxes, and utilities. For our example, these expenses total up to $120,000 annually. So, how do we figure out if this property is making money after all those expenses? We calculate what's called the net operating income, or NOI for short. Here's the simple math. We take our total income of $300,000 and subtract the $120,000 in expenses. This leaves us with an NOI of $180,000. This number is super important because it tells us how much actual profit the property could make in a year. But there's more to it. We also need to look at the cap rate, a tool that helps us understand the return on our investment based purely on the property's operations. Here's how you do it. You take the NOI, that $180,000, and divide it by the purchase price, our $2 million. Then multiply by 100 to get a percentage. Doing the math, our cap rate comes out to 9%. Why does this matter? Well, a higher cap rate generally suggests a more profitable investment. So at 9%, it looks like our property could be a pretty solid choice, depending on the market and other factors. I hope this breakdown helps you see how just a bit of simple math can reveal a lot about a property's potential. It's like being a detective in the world of real estate investing. Got any questions about this calculation or want to know more about other real estate metrics? Drop your questions in the comments below. Let's wrap it up. Today, we walked through the essential steps of analyzing commercial real estate deals, from collecting the right data and diving deep into financial metrics to assessing market dynamics and understanding potential risks. We've seen how each piece of the puzzle comes together to inform smarter, more calculated decisions. Remember, the goal here isn't just to find a good deal, it's to find a deal that's good for you and aligns with your financial goals and risk tolerance. Whether you're a seasoned investor or just starting out, mastering these analysis techniques can dramatically improve your confidence and competence in the real estate market. So, take this knowledge, apply it to your next potential investment, and see how much of a difference it makes. Practice makes perfect, and the more deals you analyze, the sharper your investing skills will become. And of course, keep learning. Every deal teaches something new. Thanks for watching. Our channel is dedicated to making investing, finance, and economic concepts easy to understand, empowering you to make smarter financial decisions. If you found this video helpful, others might too, so please share it to help them benefit as well. Help us spread the word by subscribing to our channel. Let's make finance and investing knowledge accessible to everyone. And don't forget to check out our website at www.investingcouncil.com for more information and resources. See you next time.